All down. All silent. Going. Gone. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Good afternoon, Peter. Always good to have you in the studio. Welcome back for another week of Current Market Insights.
Great to see you, Ciaran.
Look, Peter, obviously big week this week. The RBA's announced on Tuesday afternoon another rate rise. Unexpected, I think. So most of the commentary I certainly listened to over the last few weeks suggested that there wouldn't be a rise. What about yourself? Were you caught off guard by the announcement by Philip Lowe?
I didn't have a view either way. I knew this was a touch-and-go decision from the RBA, Ciaran. It was certainly unpopular. It was the most unpopular decision by the RBA probably since the first rate rise of this cycle back in May 2022. I think what the RBA were looking at is inflation is still way too high and property prices have been rising nationally. And that is something that the RBA would have been bemused by. Clearly, there was a lot of other things they were looking at. But on balance, they've gone with the interest rate rise and they've cautioned that it may not be the last one.
So you mentioned you didn't really have an opinion on this, or you didn't have any thoughts on which way they might go. I listened to a commentator earlier in the week talking about it on Tuesday afternoon, in fact, and he suggested that the fact that most finance experts didn't think there would be a rise means that, in his view, the RBA kind of failed their mandate of, readying the public in expectation of what may be happening with interest rates. Do you agree with that kind of statement?
No, because everyone's entitled to an opinion as to what the RBA will do at any given meeting. Late on Monday night, before the rate rise was decided upon, Craig James was on Money News 2GB, for example, and he felt on balance that there probably would be an increase in the rates for the reasons that we've just discussed, is that inflation was too high. It's nowhere near the RBA's target, and there are other indicators such as wages and property prices that are trending in the wrong direction. Rents are feeding into inflation. They represent the largest component of the CPI basket. And as we all know, across the country, rents are rising aggressively. So the RBA, now that the decision has been made, it's fairly obvious. I think what we saw a lot of people with confirmation bias who convinced themselves that there wouldn't be a rate rise. And for that reason, they thought that the RBA was in lockstep with their personal opinions, but clearly they weren't.
Look, I'd probably fall into that category myself, Peter. I think we talked later in last month about this. And I was of the view that they'd probably hold, given that inflation seems to be relatively stable, yet still above target. I'm glad you mentioned rent being a major component of the CPI basket. We've definitely, the inflation basket. We've talked about this before. Now, we've talked about the impact it might have, I guess, in a very general sense. But some of the commentary I've heard after this particular rate rise is that the flow-on effect actually won't impact the rental market. Now, I'm interested to get your thoughts on, increasing interest rates for investors and landlords. Is there going to be a flow-on effect for renters in the market?
Whilst ever the RBA are increasing interest rates, landlords, wherever possible, will aim to pass some or all of those rate rises off onto tenants. And they're more able to do that when there's the shortage of dwellings, as there is now in Sydney, as Sydney has filled back up and the federal government flood the country with, I think it's 400,000 migrants this financial year. So I think we can see further increases in the rental market going forward. The issues in the rental market are deep-rooted. They can't be easily fixed. You can't quickly whack up a block of apartments. Watching developers trying to do basic duplex subdivisions is a nightmare. It's a 15, 18-month process at the local council. So when the federal government want to invite 400,000 new people into the country and local councils are taking 15, 18 months to approve a duplex site, we've got serious problems, and the winners out of that will be landlords who don't carry debt because they will see the cash component from their investment properties going up quite sharply to decade-high yields.
Yeah, absolutely. And it's certainly, we've talked about the rental issues before, and no doubt we'll talk about them in the future. but it's something that everyone's struggling with, and there are so many components to that. One of the other major players that we know of is obviously energy pricing is a big contributor to inflation. And I feel like, I don't know about you, but I feel like it's definitely cost of living is feeling like there's so much more pressure on our household, and I'm sure so many others across the country at the moment.
Well, anecdotally, I think we're all seeing it and feeling it now out there in society. There's a pullback in expenditure. And people ask, why is the property market rising at the moment when there's so much evident stress in the economy? But there is a lack of stock on the market at the moment, as any home buyer will tell you. There's next to no stock in some suburbs on the market at the moment, and that's across all agencies. Not just one agency's got no stock in a certain suburb that they would normally have stock in, but there's literally suburbs of Sydney with maybe 0 or 2 listings on market at the moment. I know I looked at Lilyfield recently and it had 1 listing on the market at that point in time. And that's driven by the fact that when interest rates started rising, property bears drew a straight line between the fact that rising rates meant falling house prices. As we're now seeing, rising interest rates means that people cut back in every other area of their life in order to protect their home. So the family home, the asset base goes last. The discretionary expenditure, the non-vital expenditure, is what goes first. So if you are in a non-core business at the moment, let's say dog washing, for example, it's clearly a discretionary business, and I'd say that sort of business, not that I'm wanting to beat up on people that wash dogs for a living, but you get the idea, is that it's easy to cut out of the household budget, where people will fight tooth and nail to protect the home, and that's why stock on market is so low, and the very, very historically low stock levels is causing demand to be greater than supply, hence it's pushing up prices modestly. All dwelling prices in Sydney in the month of April 2023 rose 1.3%. So that's a fairly sharp bounce back annualised. That's running at 15% there.
Yeah, well, it's I know we've touched on in the past the type of buyer that's coming to the market. Every time we have a rate rise and we sit down and chat about it, we kind of look at what are the market conditions and what's the impact on people that we meet. I'm interested with, continually rising rents. Rising rates mean typically lower or shorter loan approval periods. This is harder for first-home buyers. Given that we've got low stock and we've got rising rents, do you think we'll see investors coming back into the market more so than when we talked about this a couple of months ago? Or do you feel like it's still a market for those who are looking for the next family home?
We haven't seen investors entering the market yet, and I don't expect to see investors enter the market, Ciaran, until they see interest rates peak and stabilise and potentially even come down a little bit, and until they see property prices completely stabilise, which a picture is forming there. So the big picture around property prices is this a dead cat bounce? Is this a consolidation phase for the market? Or has the market genuinely bottomed and can only go up from here? Everyone will have an opinion as to where we are in the cycle at the moment, but if you're asking what investors are doing, they're still on the sidelines.
So low stock levels, you mentioned Lilyfield, good example, very, very few listings on the market. If you've got sellers at the moment that you're talking to or potential clients of yours, and they've sat on the sidelines because they expected that there wouldn't be market activity, are you finding that the conversations are shifting more now towards, hey, in fact, property's done a lot better than we expected, and let's consider potentially going to the market?
Our message through March, April was that the market reality was better than the market sentiment, but we're always subject to events. And clearly there was a rate pause in April, and everyone, as we've just discussed, not everyone, but by and large, the majority of the market had convinced themselves that there'd be a rate pause in May, and that hasn't happened. There's been a surprise rate rise. So where we go from here may be different to where we've just come from. Yes, but any vendor that took the plunge and went on the market after March through that April Easter period and got sold will be pretty happy that they've at their timing, because I'm not so sure that the market can hold on to its gains, and I'm definitely not certain that it can continue rising in the face of today's interest rate rise, combined with the threat from Philip Lowe that if he sees continued inflationary pressures in the economy, he will just go again.
Yeah, exactly. I'm really interested to get your thoughts, Peter. We did have a rate pause in April. You've been watching closely, obviously, the buyer sentiment on the ground, the seller sentiment, the market condition. Have you noticed over the last few weeks a change in the conversation or a change in people's attitudes at open homes? Was there, more optimism on the ground, or were people feeling that, in fact, maybe the worst was behind us as a property consuming nation, and we might be moving out the other side?
I think all agents that I speak to are seeing the same thing, Ciaran. You put one property on the market and there's 5 parties that want to buy it. You put a near similar property on the market the following week, and there's no one that even turns up to the inspection, never mind wanting to buy it. So it's really hit and miss out there at the moment. I think the withdrawal rate is as high as it's been since the initial COVID lockdown in 2020, but nevertheless, there are the odd properties that are achieving above market price for whatever reason. There's 3 or 4 cash buyers. They've got it presented right. They have it priced right, and it just sells above expectations. So trying to understand a consistent trend line in the current marketplace, no matter whether you're looking for a 1-bedroom unit or a 400 square metre block size, good luck with that, because there is no consistency in the way the market is behaving, which is adding to the confusion.
So with all that in mind, if you are, if we've got any sellers or potential vendors listening in the podcast today who are thinking that, maybe it's a good opportunity for them to make a move in property, maybe, invest their sales return or purchase something else, whatever they might decide to do, what advice would you be giving to any potential sellers now? Given that this market is really unpredictable, we're seeing some great results, as you say, we're not seeing some great results. It's so topsy-turvy. If I was coming to you with the intention to sell, what advice would you give me as an agent?
If you are a discretionary seller, put your property on the market. You can even test it off market if you feel safer doing so initially to get a response. But put your property out there, but don't commit tens of thousands of dollars up front in an advertising campaign that's non-refundable if you don't achieve a sale price that you're happy with. Get some market feedback. Because stock is so tight, agents should be able to introduce buyers to your property without you risking any money. If you like the response coming back from the marketplace, continue with the campaign and sell it. If the market response to your property is disconnected or misaligned from your target price, just withdraw it from the market and don't continue. And that's one of the things that we've seen in the last 6 months is discretionary sellers have dropped out of the market. That's what's created the listing shortfall. So I see SQM Research's numbers today showed that listing numbers in Sydney fell by 9.5% during April. April's a very messy month in which to judge the property market, school holidays, Easter holidays, the Anzac Day inadvertent long weekend. So we had 3-4 business day weeks. So 3 weeks where it was a 4 business day week in April. That makes it a very topsy-turvy time in which to trade real estate. We'll get a clearer understanding from here. So that's the discretionary seller. Without breaking any confidences, we are speaking to people, unfortunately, that are dealing with and facing mortgage stress. And you need to be really earnest and honest in your assessment of your personal finances at the moment. Can you ride the dip? Do you have a credible plan B if there are another 1 or 2 interest rate rises and interest rates stay at this or mortgage rates stay at this elevated level? You need to be doing modelling. What does your finances look like in late 2023? What do they look like in early 2024? Because it looks like there's a bit to go before central banks globally have broken this inflation genie that has got out of the bottle.
This might be a challenging question for you to answer, and we'll give it a go. If you can't, that's fine. If you are a household and you're finding yourselves in mortgage stress and you're thinking, you're crunching the numbers trying to figure out what you can do, other than selling to get out of the difficult scenario, are there any, levers or mechanisms, other than going to family for help or anything like that homeowners can use to help weather that, shortfall in the short term, hoping that this will correct and start to move in a more positive direction?
Yeah, look, really great question, and everyone will have a different tolerance as to where they're prepared to go to answer that question, Ciaran. So depending on what one's personal household arrangements are, if I were a couple or a single person living in a 2-bedroom unit, I'd be looking at the spare bedroom as weekly income. Now, you don't have to have a flatmate in there forever, but certainly a flatmate in there for the time being to help carry the load of the mortgage is a very credible answer at the moment. If your family home is causing you mortgage stress, you can always lease that family home outright on the rental market, which will return very well for you, and go and rent a property in a lesser suburb, a cheaper location, or a smaller property in the same suburb, and you'll get a value difference there and some tax concessions as you just ride the cycle out with your family home being a short-term investment play. So there is always options, as you say. I guess there's a lot of people that are using the Airbnb scenario. And then the one that we've already discussed, which we're seeing in a big way out there in society, is people are cutting back on discretionaries, and the interest rate rise today will cause that to occur further.
All great ideas, Peter. And I guess on top of those, do you know, are there any government mechanisms or tools in place to help families out in the event that they do hit any stress here? Or is this just a case of, look, you've got an asset and you need to make a choice about it and take care of your own peace, I guess?
Look, I wouldn't be going to government agencies as a first port of call. That would be a last port of call. I think people should, as we've just discussed, be really honest in their modelling and their financial modelling of their household, and asking themselves, can they ride this cycle through? And if they can't, what other options are available to them in order to help them do so. If you've got expensive toys, that's probably time to let go of them. Boats, motorbikes, etc. Downgrading the holidays, etc. All of those sorts of things.
Cutting out the avocado.
Yeah, I'll leave that up to the individual. But you get the idea is that anywhere where you can cut costs if you're facing mortgage stress, it's a good thing to do, and is probably already being done.
Yeah, absolutely. Look, I know that you hate to be one to make predictions, but given where we're at, we've had this rate rise, I guess, somewhat unexpectedly, depending which corner of the market you've sat in. Where do you think the RBA might go next month? And obviously, as always, I don't hold you to these predictions, Peter.
Well, look, the RBA are clearly more difficult to predict than what the Fed are. So in American markets, for example, there's a saying, don't fight the Fed. Have you heard that one?
I have, yeah.
Yeah, well, it's a bit hard to fight the RBA because they've got a different message every 6 weeks at the moment. So it's very, very difficult to draw any conclusions from the dialogue. As we discussed, and as everybody knows, we were led to believe there'd be no interest rate rises until 2024, and here we are, 10 interest rate rises later.
11 now, I think.
Yeah, maybe. Yeah, maybe it is 11. You lose count after a while, don't you?
You do, yeah.
But you get the idea that the RBA had a very hawkish tone after the February rate rise this year. Then they had a more softened tone after the March meeting, and then rental rates and property prices continued to edge up with other inflationary pressures. So after they've paused in April, they've come out with a rate rise in a very hawkish tone again today. So my personal view in all of that, Ciaran, is one should watch the data and stop listening to the RBA, I'm afraid. And the fact is, the data, as Craig James said on Money News last night, inflation is nowhere near where it needs to be in its 2 to 3% target band. It's in the high sixes, and until you see that coming down rapidly, the RBA will have a hawkish tone toward interest rate rises. Not that I can promise this, but we must keep in mind that if the RBA can rapidly increase interest rates, they can also rapidly decrease interest rates. And my core prediction for 2023 was the RBA would break the economy and be forced to cut. And I still maintain that view, is that they're going to dial up and break things here, and then they will be, and they're breaking things as we go, as we're seeing company failures by the day at the moment, unfortunately. Today's news won't help anything, and whether it's late in 2023 or early 2024, the RBA will be cutting, trying to put Humpty Dumpty back together.
No, look, I think it's a well-reasoned prediction, Peter. Would be safe to say, though, for anyone listening, us included, that there's still a fair bit of pain ahead before we start to see a smoother ride in the economy altogether. There are so many things happening all over the world. Look, that about sums it up for today, I think, Peter. It's always a pleasure to have you in the studio. Thanks so much for your time.
Thanks, Ciaran.
Thank you, and I'll see you next week.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate. The podcast providing real estate insights you won't find anywhere else.